Welcome back to our weekly update. I'm Charlotte McLeod with investingnews.com, and we're going to run through a few of the week's biggest stories in the mining industry. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and of course, leave us a comment below. Let's get into it. The gold price had an active week. It started off strong, then sunk to just above the 4,000 per ounce level before staging a bumpy rebound. Silver behaved in a similar fashion, although unsurprisingly it displayed more volatility. Top of mind for market watchers was the US Federal Reserve's meeting, which wrapped up on July 29th. As was widely expected, the central bank left interest rates unchanged. Of course, there's more to the story than that. The gathering was the second with Chair Kevin Warsh at the helm, and although he said he wants to dial back communication from the Fed, all eyes were on his post-meeting press conference. There's a lot to unpack, but what seems to be front and center is Warsh's credibility. The 30-year Treasury yield rose as high as 5.24% the day after the Fed announced its rate decision, reaching the highest level since 2007. Experts are pointing to this reaction as evidence that Warsh hasn't done enough to quell concerns about inflation, with his lack of forward guidance raising worries that it could spiral out of control. There's also been talk of the Fed losing its influence on the bond market. That doesn't mean Warsh didn't say anything about inflation. He emphasized that a soft target for inflation doesn't exist, saying the Fed will stick to its 2% goal. But at the same time, Warsh called into question how inflation is measured. While he did confirm that the PCE price index is the Fed's preferred gauge, he also said that could change in January once his task forces report back to him. With all of that in mind, what's next from the Fed? CME Group's FedWatch tool points to the possibility of a hike as soon as September, but much could change in the lead-up. I heard from Alex Abkarian of Allegiance Gold right after the press conference concluded, and he said he'll be watching the August Jackson Hole meeting for more concrete guidance from the central bank, as well as clues on gold's potential trajectory.
Historically, if you look at the data on a monthly basis in the last 40 years, what we've seen is that the second half of the year, starting in August, September, October, and on, we see spike in the gold prices. Now, one aspect of that is led by some of the government fiscal year end is September. Others is some people are trying to reallocate and reshift their portfolios. But in my opinion, because of the August Fed rate decision, we're going to have a lot more clarity on the trajectory.
Steve Penny of silverchartist.com also spoke about the Fed during our recent interview, and while he said its near-term moves could provide some upward momentum for gold and silver, what will really get them going again will be its response to the next crisis.
I think, when the Fed begins to moderate its hawkish tone and any cessation to the hostilities in Iran could be a catalyst for a move up, but I don't think that'll be the catalyst to take us to new highs. That could run us up to $70, $80, $90 silver, maybe to $5,000 gold or more. But I think it's going to be the Fed's response to the next panic that sends us to way, into new all-time high territory.
I'll leave the links to the interviews with Alex and Steve below. Definitely check them out for their full thoughts on what's coming from the Fed and precious metals. The World Gold Council released its Q2 gold demand trends report this week, but it's a statistic from the first quarter that's been turning heads. The WGC has revised its Q1 number for central bank gold demand to an estimated 57 tons, down significantly from the 244 tons initially reported. The change has raised questions about what caused the discrepancy and about how central bank buying and selling is calculated, especially given that many of these global entities are notoriously secretive about their gold purchases and sales. Joe Cavatoni of the WGC was able to put the Q1 revision into context. He explained the nuances of validating central bank gold trades and characterized the update as a shift in demand categorization. Here's how he explained it.
So we do a lot of work to get information around the consumption of gold by central banks, which includes the reporting that most people report that comes through the IMF, the formal channels of necessary reporting, and where we can do it, we augment that with unreported data. Now, all the gold has to go somewhere, and at the time of reporting, we had confidence from our sources and our suppliers of that data, Metals Focus, that the information was accurate, and subsequently we've revised it. So it moved from being a central bank specific categorization of demand to the over-the-counter unknown category. So it's still there. It hasn't changed the overall demand numbers that we've produced. It's just moved from having a high level of confidence of an unreported number to an OTC number. And over time, who knows, we might see it come through in revised reports that central banks do through the formal channels.
Joe was also clear that the broader trend of central bank gold buying, widely regarded as a key driver of the metal's bull run, remains intact.
But we still see the central bank story being very prominent, and I think that showed up in second quarter. You see a large number of reported and confirmed numbers around what the central banks are continuing to do. And remember, what we've been seeing for the last 4 years are just really outstanding record-setting numbers from central banks. These are still very large levels of consumption.
We'll be publishing the full interview with Joe next week, so stay tuned for that. In the meantime, let me know in the comments what you think of the WGC's revision to Q1 central bank gold demand. Is it cause for concern or just a blip on the radar? As always, I'd love to hear your thoughts.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.